There is one metal that every electric car, every power line, every wind turbine, and every AI data center on Earth absolutely must have. Copper. You cannot move electricity without it, and the world has made enormous binding commitments to electrify almost everything, while the supply of copper is set to fall structurally short of what those commitments require. This is not a forecast buried in a report. It is simple arithmetic, and the market has not finished doing the math. I am going to walk you through 3 publicly traded ways to position for a copper shortage that the world's electrification plans make almost unavoidable. Not a single mine in a single country that one government could seize. Not a generic mining fund that owns 40 things and a strong view on none of them. Real exposure structured around a simple, powerful mismatch. Demand for copper that is set to rise relentlessly against a supply that physically cannot keep pace. This is one of the most certain commodity stories there is, because it is driven not by speculation, but by the hard physical requirements of electrification itself. The trade I want to show you is simple. Do not try to call the exact price of copper next quarter. Own the companies that produce it, develop it, and finance it, because a structural shortage rewards all 3. Let's get into it. First, a level set, because you cannot trade a thesis you do not understand. The story you have heard is copper is an important metal. The story underneath is a collision between an unstoppable wave of new demand and a supply that is structurally unable to respond. Start with why copper is special. Copper is one of the best conductors of electricity that is also abundant enough and affordable enough to use at massive scale. That combination is why it is and has long been the default metal of electrical systems. Wherever electricity is generated, moved, or used, there's copper in the wires, the cables, the motors, the transformers. Now layer on what the world has committed to do. The global push to electrify is enormous and in many places legally binding. Electric vehicles are replacing combustion cars, and an electric vehicle contains far more copper than the car it replaces. Power grids are being expanded and rebuilt to carry more electricity. And grids are, in essence, vast networks of copper and aluminum, renewable power, wind, and solar is being built at scale, and renewable installations are copper intensive. And now add the newest, hungriest source of demand, the AI data center boom, which requires a massive build-out of electrical infrastructure. And electrical infrastructure means copper. Every one of these trends, electric vehicles, grids, renewables, data centers, is a powerful, independent, long-term source of new copper demand. And they are all happening at once. Here is the part that should be tattooed on every trader's monitor. Demand can change quickly. Supply cannot. When the world decides it wants far more copper, the demand side responds fast. Factories start building more electric vehicles. Utilities start ordering more cable. But the supply of copper comes from mines, and bringing a new copper mine into production is one of the slowest, hardest things in the entire industrial economy. Consider what it takes. First, you have to find a large economic copper deposit. And the easy, high-grade, near-surface deposits have largely already been found and mined. The new discoveries tend to be deeper, lower grade, and in more difficult places. Then, once you have found it, you have to permit it, navigate years of environmental review, community consultation, and government approval. Then you have to finance it. A major copper mine can cost billions of dollars to build. Then you have to construct it. Add all of that together, and the time from discovering a copper deposit to actually producing metal from. It can stretch to 10, 15, even 20 years. 10 to 20 years. So the world has set electrification targets for the coming decade, and those targets require a great deal more copper. But the mines that would supply that copper would have needed to be started many years ago. The lead time is the trap. The demand is coming on a timeline that the supply physically cannot match. So you have relentless, multi-source demand growth on one side, and supply that takes a decade or two to respond on the other. When that happens, 3 things get extremely valuable, extremely fast. First, the major mining companies that already produce copper at scale today the ones with mines already operating. Second, the companies developing large new copper deposits, the future supply, which becomes more valuable precisely because new supply is so scarce. Third, the streaming and royalty companies that finance mines and earn a perpetual cut of their output. So I am going to give you one vehicle per layer. 3 names, 3 different ways to express the same macro bet. Name 1, Freeport McMoran, ticker FCX. You might think a copper miner is a simple bet. It digs copper. So if copper goes up, the stock goes up. That is roughly true. And the simplicity is part of why it is such a clean way to lead this trade. This company is one of the largest publicly traded copper producers in the world. It operates major copper mines across several countries, and it produces an enormous volume of copper every year. It is today a genuine large-scale producer. Now, here is the crucial advantage of owning an established producer in this particular environment. Remember the core problem? New copper supply takes 10 to 20 years to bring online. A company that already has large operating copper mines does not face that decade. Long wait, its copper is being produced right now. In a structural shortage, the asset you most want to own is production that already exists. And here is the financial mechanism that makes a producer so powerful when copper prices rise. It is the operating leverage. A mining company has a relatively fixed cost to dig and process its copper, the equipment, the labor, the energy, set largely by the mine plan. When the copper price rises, that cost does not rise with it one for one. So the profit margin, the gap between the price and the cost, widens faster in percentage terms than the copper price itself. A moderate rise in the price of copper can translate into a dramatic rise in a producer's earnings. An established producer is, in effect, a leverage bet on the copper price, and the shortage thesis is fundamentally a thesis for a higher copper price. Here is what changed in how to think about this. For a long time, copper miners were valued by the market as classic, deeply cyclical commodity companies, their fortunes swinging with the ups and downs of the global economy, and nothing more. When the economy was strong, copper demand rose and the miners did well. When the economy weakened, copper demand fell and the miners suffered. Copper was seen purely as a barometer of the industrial cycle. The electrification story changes that framing in a fundamental way. It adds on top of the old economic cycle a powerful new layer of demand that is structural rather than cyclical. Electric vehicles, grid expansion, renewable power, data center buildouts. This demand is not driven primarily by whether the economy is having a good year. It is driven by long-term, often legally mandated commitments that march forward across decades. So copper is being slowly repriced from a pure cyclical commodity into something with a structural growth story underneath it. And a structural growth story deserves a different, more durable valuation than a purely cyclical one. Read what that means for an established producer. It captures the old cyclical upside when the economy is strong. And now it also captures a rising structural floor of electrification demand that does not switch off when the economy cools. The producer is leveraged to a copper price that has a powerful new long-term tailwind behind it. So what does this mean for the stock? It means a leveraged way to own a commodity with both a cyclical engine and a powerful new structural one. When the copper price rises, whether from economic strength from the structural electrification demand or from both at once, this producer's earnings can rise sharply because of the operating leverage. This is the established large-scale anchor of the copper trade. And when copper prices are strong and a well-run producer is generating substantial cash, the best operators return a meaningful share of it to shareholders through dividends and buybacks. So you are holding a large producer, leveraged to a rising copper price with a structural demand story building underneath it, and the potential for cash returns when prices are strong. Now, here is the honest catch. The same operating leverage that amplifies the upside also amplifies the downside. If the copper price falls, this producer's earnings fall faster than the price. Again, because of the leverage, and mining is operationally hard. A major copper mine can face equipment problems, labor disputes, or government interference. You accept that a producer is more volatile than the copper price itself in exchange for the leverage exposure to a metal with a genuine structural shortage building. Now, the bear case, 3 things to watch. 1, the operating leverage cuts both ways in a sharp economic downturn. The copper price can fall and this producer's earnings can fall faster. 2, mining carries genuine political risk. Copper mines are often located in countries that can raise taxes, tighten regulation, or interfere with operations. 3, copper stocks have already moved as the electrification story has become widely understood. So some optimism is reflected in current prices. So how do you trade it? I am not going to give you a price target. Price targets are how analysts get quoted, not how traders make money. I will give you the framework. This is the established leverage anchor of the copper trade, a large producer whose earnings amplify the moves in the copper price. Watch 2 things on every quarterly report. First, the company's production volume and its cost per pound of copper, whether output is holding up and costs are controlled. Controlled costs are what let the operating leverage work in your favor. Second, the copper price itself and the demand signals behind it, the data on electric vehicle sales, grid investment, and data center buildouts. As long as costs stay controlled and the structural demand signals keep building, the thesis is intact. If costs run away or a major mine faces serious government interference, that is the signal to reassess. Name 2, Ivanhoe Mines. It trades in Toronto, and there is a U.S. traded depository form. The ticker investors usually track is IVPF. This is, in my view, one of the most leveraged ways to own the copper shortage. And to understand why, you have to understand a different kind of mining company. The first thing we discussed is a producer. It has operating mines, generating copper and cash today. This name is best understood as a developer, a company whose central value is built around bringing large world-class copper deposits into production. Now, why would you want a developer rather than a simple producer? Here is the logic. Remember the core problem. The world is structurally short of future copper supply. Because new mines take 10 to 20 years to build, that means a large, high-quality, genuinely developable copper deposit is an extraordinarily scarce and valuable thing. The world desperately needs new copper mines, and there are very few large new copper deposits of real quality available to be built. A company that controls one of those rare, large, high-grade deposits effectively owns a piece of the future copper supply that the world cannot do without. And this company has built its reputation on exactly that, on being associated with the discovery and development of some of the most significant copper deposits found anywhere in recent decades. It is, in essence, a way to own scarce, world-class copper supply that is coming online. The answer to the very shortage the thesis describes. Why is a developer so much more leveraged than a producer? Because of how the value of a copper deposit changes as it moves through its life. When a copper deposit is just an exploration target, a promising patch of ground, it is worth relatively little, because there is enormous uncertainty about whether it will ever become a mine. As the company drills it, proves up the size and the grade of the ore, completes engineering studies, secures permits, arranges financing, and finally builds the mine and begins production, the deposit becomes progressively, dramatically more valuable. Each step that reduces the uncertainty and moves the deposit closer to producing metal can add substantial value. So a developer offers a different kind of upside than a producer. A producer gives you leverage to the copper price. A developer gives you that plus a second source of return. The value created as its deposit advances along the path from undeveloped ground toward a fully operating mine. In a copper shortage world, both of those work powerfully in the same direction. The rising copper price makes the deposit more valuable, and every step of development also makes it more valuable. And there is a third element, a genuinely large, high-quality copper deposit, once it is in production, can produce copper for decades. So this is not a short-life asset. It is a multi-decade source of copper brought online into a structural shortage. That long production life is itself a major part of the value. The things to watch for a developer are different from the things you watch for a producer. The first is the development progress, the concrete milestones as the deposit advances. Is the construction on schedule? Is the mine ramping up toward its planned production rate? Is each phase of the project being delivered? These milestones are the heartbeat of a developer. Each one achieved reduces risk and adds value. The second is the production ramp. As the mine begins operating, whether the output is climbing toward its full design capacity. A mine does not reach its full production overnight. It ramps up over time. A successful on-track ramp is powerful confirmation that the deposit is becoming the cash-generating mine. The thesis depends on, so you watch the development milestones and you watch the production ramp. When the project is advancing on schedule and the ramp is on track, you have a developer successfully converting a scarce, world-class copper deposit into real production, exactly as the shortage thesis needs. That is the case. A higher torque way to own copper, levered to both the metal price and the value created as a rare large deposit, comes to life. And here is the kicker. A successful developer undergoes a fundamental transformation that the market rewards. It starts as a company valued on the promise of its deposits, on what they might one day become. As it brings a mine into production, it transforms into a company valued on real, actual copper output and real cash flow. That transition from promise to production is often when a developer is re-rated most significantly by the market. Now, the honest catch, and it is a serious one. A developer is genuinely higher risk than an established producer. Building a major mine is enormously complex. Construction can run over budget. Timelines can slip. The production ramp can disappoint. And many of the world's great copper deposits are located in challenging parts of the world, which adds real political and operational risk to the development. So this is the higher risk, higher reward leg of the copper trade. Read it correctly. The greater leverage of a developer is real, but so is the greater risk, which is precisely why it belongs as one measured leg of a basket, not as the whole trade. You size it accordingly, and you balance it with the steadier producer. The bear case: 1. A developer carries real execution risks. Mine construction and the production ramp can run over budget or behind schedule. 2. World-class copper deposits are often in challenging locations, adding political and operational risk. 3. A developer's value is sensitive to the copper price and to market sentiment toward mining, and it can be volatile. How I think about the trade. This is the higher torque developer sleeve of the copper trade, leveraged to both the copper price and the value created as a rare large deposit is brought into production. If you believe the world is structurally short of future copper supply, and the mine lead times say it is, then a company bringing scarce world-class copper supply online is powerfully positioned. Watch 2 things: the development milestones, whether the projects are advancing on schedule, and the production ramp, whether output is climbing toward design capacity. As long as the projects advance and the ramp stays on track, the developer is executing the thesis. If construction badly overruns or the ramp stalls, that execution gap is the signal to reassess. Name 3. Triple flag precious metals, ticker TFPM. We have covered an established copper producer and a copper developer, but both of those carry the operational risk of actually digging metal out of the ground. There is a third kind of company in the mining world that captures the upside while sidestepping much of that operational risk, and most investors have never heard of it. It is called a streaming and royalty company. Here is how it works. A mining company developing or expanding a mine needs a large amount of money up front. Building and growing a mine costs a fortune. A streaming company provides that money, but it does not provide a loan to be repaid. In exchange for the upfront capital, it signs a contract giving it the right to either receive a percentage of that mine's metal output or to buy that metal at a steeply discounted, pre-agreed price for the entire life of the mine. Read that carefully. The streaming company pays once up front and then receives a slice of that mine's production for decades. It owns a perpetual cut of the mine's output without ever operating the mine itself. Now, a quick point of honesty about this particular name. Its book of streams is diversified across different metals. It is not a pure copper company, but that is exactly why it works as the third leg of this basket. It gives you exposure to the same mining and metals strength. The copper thesis is built on captured through a fundamentally different and lower risk structure. This is the layer the market consistently underthinks. This company is a streaming and royalty company holding a diversified portfolio of streams and royalties across a range of mines operated by other companies. It does not run those mines. It collects a contracted share of their output. Here is why the streaming structure is so powerful, especially in a metals shortage environment. Think back to the producer and the developer and their biggest vulnerabilities. The producer is exposed to rising costs when diesel, labor, and equipment get more expensive. Its costs rise and its margin gets squeezed. The developer is exposed to construction risk. Budget overruns and schedule slips both carry the full operational burden of mining. The streaming company is structurally insulated from much of that. Its cost to acquire metal is fixed in the original contract, a low pre-agreed price. So when mining industry costs surge across the world, the operating miner absorbs that pain. The streaming company's acquisition cost does not move. That means the streaming company can capture the upside of rising metal prices while being largely shielded from the cost inflation that squeezes the miners. And it does not bear the direct burden of a construction overrun the way a developer does. It gets exposure to the metal and to the mine's success without carrying the full operational risk of digging. And there is a second great advantage: diversification. A single mine run by a single company carries the risk of that one operation. A streaming company holds claims across many mines, many operators, many countries, and often several metals. If one mine underperforms, it is one stream among many. The portfolio absorbs the blow. And here is the kicker, the feature that makes the streaming model genuinely special: free optionality. When a streaming company signs a deal, it gets a cut of everything that mine produces over its entire life, including ounces and tons that have not even been discovered yet. Mines are routinely expanded. Operators drill deeper, find more body, extend the mine's life, or raise its output. When that happens, the streaming company's slice of the larger production grows too. And it did not pay an extra dollar for that growth. It was already written into the original contract. So a streaming company gets to benefit for free from every exploration success and every expansion across its entire portfolio of mines. That is how a streaming company compounds, not by digging harder and not by bearing the operational risk, but by holding a diversified book of perpetual claims on mining output, capturing rising metal prices without the cost squeeze, and absorbing decades of free production growth as its operators expand. It is unglamorous, it is incremental, and it compounds. And streaming companies have historically operated with very high profit margins because they have so few of the costs that weigh on a real miner. The honest catch: a streaming company depends on its operating partners. If a mine it has a stream on is run badly or shut down, its share of that output falls, and it has no control over the operation. But across a diversified portfolio, that risk is spread thin. And that is the point of the structure. The bear case: one, the company depends on its operating partners. A mine that is run badly or shut down reduces its stream income, and it has no operational control. Two, this name is diversified across metals rather than being a pure copper play. So it is an indirect way to express the copper thesis specifically. Three, streaming companies often trade at premium valuations because the model is so attractive, so disappointment is punished. How to trade it? This is the lower operational risk, diversified sleeve of the metals, shortage trade, exposure to mining strength without the cost squeeze and construction risk that weigh on a producer or a developer. You watch two things: the volume of metal actually delivered under the company's streams and royalties each quarter, and the pace of new deals signed, the pipeline of future claims. As long as deliveries hold and the company keeps signing well-priced new deals, the compounding engine is running. If deliveries fall because partner mines are struggling or the company cannot source new deals, the growth part of the story is what fades. Now, and this is important, I would not bet the whole thesis on any single one of these names. I would think of them as a basket. Why a basket? Because the three give you the same copper shortage bet at three very different levels of risk. The established producer is the leverage core, copper being produced today, earnings that amplify the copper price, real cash flow, but full operational and cost risk. The developer is the higher torque sleeve, leverage to the copper price and to the value created as a rare large deposit comes online, but carrying real construction and ramp risk. The streaming company is the lower operational risk leg exposure to mining strength, insulated from cost inflation and construction risk, diversified across many mines and metals. Notice that these are three different risk profiles, not three different bets. A construction overrun at the developer does not touch the producer's operating mines. A cost spike that squeezes the producer largely bypasses the streaming company, whose acquisition cost is fixed by contracting. When you blend the leverage producer, the higher torque developer, and the insulated financier, you get the copper shortage thesis across a spectrum of risk instead of betting everything on one company or one structure. When you hold all three, the exposures roughly diversify each other while keeping the central macro bet intact. The world has committed to electrifying almost everything. That electrification physically requires far more copper than the supply can deliver, and the producers, the developers, and the financiers of copper mines all get paid for that gap. One caveat: if you are going to trade the copper shortage theme, you have to respect its real risks. Copper still has a strong cyclical element. A severe global recession would cut industrial demand for copper, and even with the structural electrification story building underneath, the price could fall hard in a genuine downturn. And the structural demand itself depends on the electrification commitments being carried through. A dramatic slowdown in electric vehicle adoption or grid investment would soften the long-term picture. But read the long arc correctly. The electrification commitments are large, widespread, and in many cases legally binding. And the supply problem is not a matter of opinion. It is physics and time. New copper mines take 10 to 20 years to build, and that lead time cannot be wished away. I do not think the shortage thesis breaks soon. The demand drivers are too broad and the supply response is too slow. But copper can be volatile, and a recession can hit it hard. So you size the basket with discipline and you accumulate on the pullbacks. Position, size accordingly. Do not max out on any single name, and keep dry powder for when a recession scare sends copper and the whole mining complex down together. Because that is when you accumulate a structural shortage at a discount. A few catalysts I am watching going forward. 1, the copper price itself and the inventory data. How much copper is sitting in warehouses, which signals whether the market is tightening. 2, electrification demand signals. Electric vehicle sales, grid investment plans, and data center build-out announcements. 3, new copper mine supply. Any major new projects being approved, delayed, or disrupted. 4, the development milestones and production ramps at the major copper developers. If any single one of these key metrics cracks decisively, I will revisit the thesis on this channel. 2 more names to keep on a watch list, but I am not buying today. Southern Copper, another large copper producer with extensive operations and reserves, a different way to own established copper production. And BHP, one of the largest diversified mining companies in the world, with major copper operations inside a broader portfolio of metals. I will cover both in future episodes when I have more conviction. Let me leave you with the macro frame. For more than a century, copper was treated as a simple, humble industrial metal, a barometer of the economic cycle, valuable but unremarkable, the quiet wiring inside the modern world. And as a pure cyclical commodity, that is how the market priced it, up when the economy was strong, down when it was weak, and not much more to the story. But the world has now made a decision that changes copper's role entirely. It has decided to electrify almost everything. The cars, the power grids, the energy supply, and to build On top of all of that, an enormous new layer of electrical infrastructure for the age of artificial intelligence. And every single piece of that vast project runs on copper. There is no electrification without it. There is no substitute that works at the same scale. So copper is being quietly transformed from a humble cyclical metal into one of the most strategically essential materials of the coming decades. And here's the part the market is still catching up to. The demand is rising on a timeline of years while new supply arrives on a timeline of decades, because a copper mine simply cannot be built any faster than physics and permitting allow. That mismatch, relentless electrification-driven demand against a supply that physically cannot keep pace. That mismatch is the trade. The producer, the developer, and the streamer are not a bet on a single economic cycle. They are a way to own the metal that the entire electrified future has to be built out of. You cannot wire the world without copper, and there is not going to be enough of it. 3 vehicles, 3 layers of exposure. 1 macro bet. Freeport produces the copper today. Ivanhoe brings new copper online. Triple Flag finances the mines for a perpetual cut. If the thesis is right, all 3 compound. If the thesis cracks, you will see it in a handful of specific metrics, and I will tell you here. That is the trade. That is the headline behind the headline. If this kind of breakdown is useful to you, the kind where we do not just react to the headline, we trade behind it. Hit subscribe. I will see you on the next one.